The blockchain wars are no longer some distant concept playing out on crypto Twitter. They are here, and institutions are starting to realize that sitting on the sidelines is no longer an option. Every bank, every payment processor, every central bank exploring digital currency is going to face the same question: what infrastructure do we build on? Because this next phase isn't about speculation, it's about integration, it's about plumbing, it's about the rails that will quietly move value behind the scenes while the world barely notices the transition happening underneath it all. And this is where the XRP ledger begins to separate itself from the noise, not because it shouts the loudest, but because of what it was built to do from day one. When you zoom out and look at the financial system as a whole, you start to see the real opportunity. Central banks issuing CBDCs, commercial and correspondent banks moving cross-border liquidity, payment processors and gateways settling transactions globally, remittance companies pushing funds across continents, FX trading desks and liquidity venues managing flows in real time, broker-dealers, investment banks, central securities depositories, stock and bond markets, derivatives platforms, asset managers, fund managers, e-money wallets, fintech neobanks, payment apps, merchants, buy now, pay later providers, centralized exchanges, decentralized exchanges, stablecoin issuers, NFT platforms, corporate treasury systems, trade finance networks, supply chain platforms, real estate tokenization markets, government payment rails, identity and compliance systems, even legacy networks like SWIFT and domestic real-time gross settlement systems. All of it exists, all of it operates, all of it, and almost none of it talks to each other efficiently. That's the real problem: disconnection. And we can get excited about announcements and partnerships all day long. But the real question people ask is simple: how does this actually connect? How do you stitch together dozens of networks that were never designed to interoperate? Because blockchains by themselves don't magically fix fragmentation. Each chain is still its own silo, just like traditional finance, just like the legacy systems we're trying to evolve past. If every blockchain is an island, then we've simply recreated the same problem with new branding. And this is where the idea shifts. Instead of asking institutions to pick a winner, instead of walking into a bank and saying, choose this chain, choose this token, choose this ecosystem, maybe the smarter move is different. Don't force a decision at the protocol level. Get them through the front door first. Implement a wallet, implement infrastructure that connects to all chains. Don't ask them to bet the future of their balance sheet on one asset. Give them interoperability, give them optionality, give them a system that routes value the way the internet routes data. Because that's the analogy that matters. The internet didn't win because one network replaced all others. It won because it connected independent networks together and routed packets of information seamlessly between them. What we need now is the financial equivalent, a system that can route packets of money across independent payment networks. A system where I can hold some obscure digital asset and you can receive dollars, and neither of us needs to care what's happening in the middle. Once traditional finance and Web3 are properly interconnected, once the pipes are laid and the doors are open, that's when the real competition begins, not before, after the infrastructure is in place. When people say that to connect every chain and every payment system, the technology would have to be open sourced, they're actually pointing in the right direction. Because what's being described isn't a closed corporate product that one company controls behind locked doors. It's a protocol layer. And protocol layers, if they're going to succeed at global scale, have to be neutral. They have to be accessible. They have to invite participation instead of restricting it. That's where Interledger comes in. It started at Ripple, but it was never meant to be owned in the traditional sense. It wasn't designed to be a proprietary moat. It was introduced as a community project, something bigger than a single balance sheet, something that could outlive the company that helped incubate it. Adrian Hope Bailey explained this clearly in an interview, emphasizing that Interledger is a protocol for connecting different ledgers. That word connecting is doing a lot of heavy lifting, because the real problem in global finance isn't the absence of networks, it's the overabundance of disconnected ones. Every blockchain is its own ecosystem, every bank has its own core system, every country has its own payment rails. They all function internally, but they don't naturally speak to one another. And that fragmentation creates friction, it creates cost, it creates delay. Interledger doesn't attempt to replace those systems. It doesn't try to force everyone onto a single chain. Instead, it acknowledges reality. The networks exist, they're not going away, so the solution is to connect them. Yes, blockchain ledgers are part of that vision, but it extends far beyond crypto. Interledger can connect any payment network, that's the key. It doesn't care whether the underlying system is a public blockchain, a private distributed ledger, a traditional bank database, or even a mobile money platform. It operates similarly to IP on the internet, acting as an interoperability layer above independent systems. The internet didn't win because one network consumed all others. It won because IP allowed packets of data to travel seamlessly across separate networks without the end user needing to understand the complexity underneath. Interledger applies that same philosophy to value. Instead of forcing everything onto one chain, it routes value between them. That's a fundamental shift in thinking. Rather than asking institutions to choose a winner, it allows them to remain on their existing infrastructure while still participating in a broader ecosystem. That lowers resistance, it lowers risk, and it makes adoption far more realistic because banks and financial institutions aren't going to rip out decades of infrastructure overnight, but they might plug into a protocol that lets them interoperate with the rest of the world. And once that interoperability layer is in place, the entire conversation changes from competition to connectivity. It operates within the World Wide Web Consortium as an open community group, with hundreds of members participating in shaping its direction. That structure is not a small detail, it's foundational, because when you're building something that is meant to sit above financial infrastructure worldwide, neutrality matters, governance matters, openness matters, a protocol that connects banks, blockchains, payment processors, fintech platforms, and potentially even central banks cannot feel like it's owned by a single commercial interest. By anchoring development within a standards body, the project signals that this is about shared architecture, not corporate control. That gives institutions confidence. It lowers the psychological barrier to participation. Protocols don't really compete the way companies do. Companies compete for market share, for revenue, for customers. Protocols aim for adoption and utility. If someone wants interoperability, the logical move isn't to build a rival silo and fragment the ecosystem even further. The logical move is to collaborate on a shared standard that everyone can benefit from. That's how the internet scaled. That's how email works across providers. That's how web browsers render the same pages. Competing standards in a space that demands connectivity don't create winners, they create friction. So the goal isn't domination, it's connectivity. It's about ensuring that value can move as freely as information does today. And that brings us to the bigger conversation about fear in the market whenever Swift mentions blockchain integration. Every time Swift talks about experimenting with distributed ledger technology or tokenized assets, a wave of anxiety moves through parts of the crypto community. People frame it as a battle line. Traditional finance versus decentralized finance, legacy rails versus blockchain. But that framing assumes a zero-sum game. It assumes that one side must eliminate the other to survive, and that's a false choice. A blockchain by itself doesn't solve interoperability. It's still a separate network. It still has its own validators, its own rules, its own ecosystem. If it can't connect outward, it's just another island. And the irony is that many of the blockchains created to escape legacy fragmentation have simply recreated fragmentation in a new form. Thousands of chains, each with their own token, their own liquidity pools, their own standards. Without interoperability, you haven't solved the problem, you've multiplied it. So when Swift explores blockchain, it doesn't automatically mean replacement. It could just as easily mean integration. It could mean layering distributed ledger technology into an existing global messaging framework. It could mean building bridges instead of walls. And if interoperability protocols are already in place, then traditional systems and blockchain networks don't have to compete. They can coexist. They can complement each other. The future doesn't belong to the loudest chain. It belongs to the networks that connect everything together. When Swift talks about adding blockchain-based infrastructure for tokenized value movement, that's not an extinction event for crypto. It's not a declaration of war. It's not a signal that decentralized innovation is about to be absorbed and neutralized. It's something much simpler and much more significant. It's an acknowledgement that digital assets are part of the future financial landscape. Institutions at that level do not experiment publicly unless they see structural change coming. If Swift is integrating blockchain components into its technology stack, that tells you the conversation has shifted from if to how. But here's the part that often gets missed. Even if Swift deploys its own distributed ledger infrastructure, it still requires settlement processes. It still requires interoperability technology. A blockchain by itself does not magically create global liquidity. It does not automatically connect to commercial banks, central banks, exchanges, liquidity providers, or corporate treasuries. If it operates in isolation, it's just another network. And a closed blockchain, no matter how advanced, is still centralized in practice if it cannot freely interoperate with external systems. It still needs routing layers. It still needs bridges. It still needs a mechanism for moving value beyond its own perimeter. That's why the idea that Ripple replaces Swift completely misses the nuance of what's happening. The financial system is not being reset overnight, it's evolving in layers. Ripple doesn't have to eliminate Swift to succeed. In fact, Ripple can complement Swift. Ripple's technology stack, including the XRP ledger and interoperability protocols, can plug into existing financial rails and enhance them. The relationship doesn't have to be adversarial, it can be symbiotic. Take foreign exchange as an example. Today, cross border payments often involve multiple correspondent banks, pre funded accounts, and delayed settlement. If XRP serves as a neutral bridge asset, it can provide real-time liquidity between currency pairs. There's no reason that liquidity flow couldn't interact with Swift's messaging network. XRP could theoretically move as a settlement asset while Swift continues to handle standardized financial messaging. One layer communicates, another layer settles. That's convergence, not replacement. These systems are not opposites. They are converging layers of the same global architecture. Traditional finance brings regulatory frameworks, institutional relationships, and decades of operational trust. Blockchain infrastructure brings programmability, transparency, and near instant settlement. When you combine them thoughtfully, you don't get conflict, you get efficiency, you get optionality, you get a more connected system. The future isn't about tearing down legacy rails and starting from scratch. It's about upgrading them. It's about adding new layers that allow tokenized value to move as seamlessly as information does today. And if Swift is exploring blockchain and Ripple is building interoperability, then what we're witnessing isn't a battle. It's the gradual merging of two worlds that we're always going to meet in the middle. Stephen Thomas once explained that XRP was used in interledger flows for practical reasons. It wasn't framed as a philosophical stance or a maximalist argument. It was presented as an engineering decision. XRP is cheap to transact, it settles quickly, it has deep liquidity across multiple markets. Those characteristics make it useful as a bridge asset when you're routing value between independent networks. That's not ideology. That's math. That's throughput. That's cost efficiency. When you're designing infrastructure meant to move money across borders and across ledgers, you prioritize speed, reliability, and liquidity. The asset becomes a tool inside a larger system, not the centerpiece of a marketing narrative. And that perspective changes how you view the broader ecosystem. Because if interoperability is the goal, then the conversation shifts away from tribal debates about which chain wins. Instead, it becomes about how you create entry points into the system. That's where wallets come in. The wallet is the front door. It's the interface that institutions and users interact with. If a bank integrates a wallet that connects to multiple chains through protocols like Interledger, then it doesn't have to make an irreversible bet on a single blockchain. It gains flexibility, it gains access, it gains optionality. Think about how powerful that is from an institutional standpoint. Financial institutions are not venture capital funds chasing upside at any cost. They are custodians of capital. They safeguard pensions, corporate treasuries, sovereign reserves, and retail deposits. They operate under regulatory scrutiny, shareholder pressure, and systemic responsibility. When you manage billions or even trillions in client funds, you don't gamble on emerging infrastructure lightly. You don't wake up one morning and decide to migrate core payment rails onto a single blockchain because it's trending. The reputational, operational, and regulatory risks are far too high. They can't afford to pick a winner prematurely and then discover 5 years later that liquidity fragmented, standards shifted, or a superior network emerged. But if they implement wallets connected to multiple networks, that entire dynamic changes. They're no longer forced into a binary decision. They don't have to crown a single protocol as the future of finance. Instead, they gain flexibility at the infrastructure level. Through interoperability layers, they can route transactions dynamically. They can tap into whichever asset or ledger offers the best liquidity corridor at a specific moment. If one network provides lower fees for remittances, they can use it. If another offers deeper FX liquidity during market volatility, they can shift there. If regulatory clarity strengthens around a particular asset in one jurisdiction, they can adapt. The infrastructure abstracts the choice, it separates access from allegiance. Once traditional finance and Web3 are connected through interoperable wallets, that's when the real competition between assets begins, not before. Before integration, most of what we see is narrative driven. It's speculation, it's branding, it's communities defending their preferred ecosystem. But once banks, payment processors, and fintech platforms are actually plugged in, the conversation shifts from ideology to metrics. Which asset settles fastest under heavy transaction load? Which one maintains consistent liquidity during macro stress events? Which ledger integrates cleanly with KYC, AML, reporting standards, and audit requirements? Which network demonstrates uptime and resilience over years, not months? That's when performance data replaces marketing. The front door is connectivity. If institutions aren't connected, nothing else matters. And you can build the most technically advanced blockchain imaginable, but if banks and payment providers cannot integrate without massive operational overhaul, adoption slows to a crawl. Integration is the first milestone, it's the foundation. The race doesn't truly begin until networks are interoperable and the rails are live. Once that infrastructure is in place, assets compete on utility, reliability, and efficiency. And at that point, engineering decisions carry far more weight than slogans, headlines, or social media momentum.